Let's take a look at the sectors. A lot's been going on since I've been gone. Really extraordinary stock market moves, but a bit flattish today. Tech's okay. Apple, Intel were on the upside. Banks have been a major problem, but they're slightly to the upside today. Retail is not the leadership group it was a few weeks ago. And energy, well, that's been a real bright spot for the last couple of weeks. I just want to point out how extraordinary the market's been this year. All those old Wall Street chestnuts, the old warning signs we used to see, the seasonal ones, none of them have been working so far this year. Remember sell in May and go away? That didn't work. Remember the old idea that the two quarters in the midterm election were down? This is a remarkably consistent indicator going back to World War II. Usually these two quarters are down. Didn't work. Both quarters were up. And remember, September's a down month? That didn't work either. And it's very rare to see August and September up, only about a third of the time since 1950. So a lot of things have kind of like fallen by the wayside. And if you're looking for why is this happening, just look at the earnings situation. Once again, third quarter, we have a shot at 25% earnings growth in the third quarter, and only about a third of that is tax cuts. We have revenue growth of 10%. Remember, almost in the other two quarters, 8% in the third quarter. That's the real thing powering the markets, but it's not the only thing. If you look for other factors and why the heck is the market so strong, we're looking at GDP growth of 3% this year. When did that happen last? 2005, 2006? Unemployment, 1960s levels for unemployment right now. Consumer confidence is near a record. And there are some risks that are out there that are quite noticeable. I would say the China trade war risk is quite noticeable. But elsewhere, the marginal risks are pretty far down the list. The recession probability, very low right now. A number of companies have written about that recently, including Stifel. And I want to just point out a couple of things to be careful about. The Russell has been dramatically underperforming in the last month. Here's the Russell 2000. Just put that up again. I want to put that out. We have seen the collapse of the whole go long small cap trade because the trade wars are starting to work out, and that's been a trade that's been working all year. Keep your eye on that one. Second thing is the banks. Put the banks up here. That's another sector. The KBE, the bank index, is close to a 52-week low. It's been a rough year for banks. Most of the big ones, as you see here, have been underperforming, including Citigroup. JP Morgan's perhaps the only outlier. It's up about 6%. But by and large, it's been a very tough time for them. Why are the banks lagging? There are a number of important factors. The yield curve has been flat. Remember, it's not just about rates going up. Raising the short end, which is what the Fed is doing, but when the long end doesn't move as much, you've got a flat yield curve. Loan growth has been lackluster, only about 1.5%, 2%. Deposit costs have been higher. They're paying more in interest rates to their depositors. And overall costs are still high. They're investing an awful lot of money in new technology so you can do mobile banking on your phone. Tough year for the banks. The rest of the market's still doing pretty well. Guys, back to you.